Hello everyone, welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 9 from the book How to Swing Trade by Brian Pazim. It has been created with the help of AI. The chapter is titled Technical Analysis Patterns. You can read the original post at samfury.com.
All right, get ready, because today we're diving deep into swing trading patterns. We're going to crack open Chapter 9 of How to Swing Trade by Brian Pazim, and we're going to try to learn how to spot some of those signs in the market that point us towards profitable trades, those clues that maybe we've been missing.
Sounds good.
So where do we even begin with this whole pattern thing? I mean, there are tons of them, right?
Yeah, absolutely. There are a lot of patterns out there. But before we get too deep into the weeds, let's just take a step back and remember that golden rule of swing trading. The trend is your friend.
Okay, yeah, that makes sense. So you don't want to be fighting against the current, right?
Exactly. You don't want to be shorting a stock in a raging bull market. It's like swimming upstream. It's exhausting. It's usually ends in frustration. So the first step is always to identify the prevailing trend. Are we in an uptrend, a downtrend, or are things just kind of moving sideways?
Okay, so once we've got that trend figured out, how do the patterns come into play then?
Well, think of patterns as clues that can either confirm the existing trend or hint at a potential reversal.
Ah, okay, so some patterns are like saying, hey, keep riding this wave, and other ones are like, uh-oh, time to maybe change course.
You got it.
Okay.
That's a great analogy. So let's, why don't we start with a classic reversal pattern, the double top, and it's a bearish twin, the double bottom.
Yeah, I've heard of those. They literally look like an M or a W on the chart, right?
Exactly. So picture this. A stock's price is moving upwards, making higher highs. That's your uptrend, okay?
Okay.
But then it hits a resistance level, stalls out, and pulls back. Then it rallies again, tries to break through that resistance, but fails, forming a second peak roughly at the same level as the first, and that is your double top. It's signaling a potential shift from an uptrend to a downtrend.
So those two peaks, or those two tops, are kind of like the bulls running out of steam.
Exactly. They've tried twice to break through that resistance and failed. And that's a sign that the sellers might be taking control.
Okay, so if we see that M forming, what's the play?
So you wait for confirmation that the trend is indeed reversing. A common confirmation signal is when the price breaks below the neckline, which is that support level that connects the lows between those two peaks.
Oh, okay. So it's not just about spotting the M. We need that confirmation break below the neckline to really trigger the trade.
Right. That helps you avoid those false signals. And it confirms that the sellers are truly in control. Then you would typically enter a short position, aiming to profit as the price moves lower.
Makes sense. Now, what about the double bottom? It's the same idea, just flipped around.
Exactly. Instead of two peaks, you have two valleys or bottoms, forming that W shape. This typically happens after a downtrend, indicating that the sellers might be losing their grip.
So the price has been moving down, but it hits a support level, bounces up a bit, then drops back down again to retest that same support level, but fails to break through.
You got it. It's like the bears are trying to push the price lower, but are meeting really strong buying pressure at that support level. And when they fail to break through on that second attempt, that's your signal that the bulls might be starting to take charge.
So I'm starting to see how these patterns really give you that visual representation of the tug of war between buyers and sellers.
Exactly.
Okay.
And just like with the double top, you'd want to look for confirmation with the double bottom as well. In this case, the confirmation comes when the price breaks above the neckline, which is the resistance level that connects the highs between those two bottoms.
And that breakout above the neckline would be our signal to enter a long position, right?
We got it.
Yeah.
We're looking for those signs that the trend is shifting, and then using the pattern to pinpoint our entry and exit points.
This is starting to make a lot of sense. Now, you mentioned confirmation signals. How exactly do we confirm that these patterns are really giving us reliable signals?
Well, the neckline break is one key confirmation, but we also want to see what other indicators are telling us. Like, are there increasing volume surges accompanying the breakout? Are momentum indicators like RSI supporting the move?
Yeah.
Are there any candlestick patterns that reinforce the signal?
So it's all about gathering evidence and making sure all the snars are aligning before you jump into a trade?
Exactly.
Okay.
Now, let's move on to another type of pattern that's particularly interesting, continuation patterns. These patterns suggest that the existing trend is likely to continue after a brief pause or consolidation.
Okay, so these are like the keep riding the wave patterns we talked
Yeah.
about earlier.
Exactly.
They like it.
So one of the most common and visually striking continuation patterns is the flag pattern.
Okay.
So imagine this. A stock is rallying strong, making a powerful upward move. That's your flagpole.
Okay.
Then the price takes a breather, consolidating in a tight sideways range that resembles a flag.
I can picture it. So the flagpole represents that initial surge of momentum, and the flag is like that pause before the rally resumes.
Exactly. And here's why flags often signal a continuation of the trend. That initial strong price move indicates really strong buying pressure. During the flag phase, some traders might take profits, while others might be waiting for a pullback to enter the trade.
So the flag represents a period of consolidation, where the buyers and sellers are kind of regrouping.
Precisely. And once that consolidation is over, the buyers often regain control, pushing the price higher and continuing the trend.
Okay, so if we spot a flag forming after a strong price move, what's the strategy?
So you wait for the price to break out of the flag, confirming that the buyers are back in control. The breakout typically occurs in the direction of the flagpole, signaling that resumption of the original trend.
This is fascinating. So we're essentially using the flag to identify a potential entry point after a strong move, letting us ride the continuation of that momentum.
Exactly. And remember, there are bearish flags too. It's the same concept, but in a downtrend. You have a sharp downward move, the flagpole, followed by a period of consolidation, the flag, and then a potential breakdown below the flag, signaling a continuation of the downtrend.
Okay, I'm starting to see how understanding these patterns can help us anticipate market moves and pinpoint those key entry and exit points. This is definitely starting to feel like we're decoding a secret language here.
It is.
Yeah.
That's the idea. And there's a whole family of patterns that can help you do just that. So let's take a closer look at another continuation pattern, the pendant.
Right, pendants. What makes them different from flags?
Well, while flags are like taking a quick coffee break during a rally, pendants are more like settling in for a nice tea time. They form when the price consolidates in a triangular shape with converging trend lines after a strong price move.
Okay, so instead of those parallel lines we saw on the flag, the lines of the pendant taper inwards, kind of like a triangle.
Precisely. The converging trend lines suggest that the price action is getting tighter, creating a sense of anticipation for a potential breakout.
And like flags, pendants signal a continuation of the trend.
Exactly. They suggest that the initial momentum is still intact, but the market is taking a bit more time to gather steam before resuming the move.
So if we see a pendant forming after a strong uptrend, we'd expect the price to break out to the upside, continuing the rally.
That's the general idea.
Okay.
And just like with flags, we look for confirmation by waiting for the price to break out of the pendant decisively. A break above the upper trend line of the pendant would confirm a bullish continuation, while a break below the lower trend line would suggest a bearish continuation,
Okay.
if we're in a downtrend.
This is all starting to click. We're looking for these patterns to confirm the trend and guide our entry and exit decisions. Now, before we move on to some other fascinating patterns, let's dive a little deeper into the trading strategies for these continuation patterns. We've talked about entry points, but what about stop loss placement and profit targets?
You're asking all the right questions. So let's start with stop loss placement, because managing risk is crucial in trading. With flags and pendants, a common approach is to place your stop loss order just outside the opposite side of the pattern.
Okay, so for a bullish flag or pendant, we'd place our stop loss just below the lower trend line.
Exactly. That way, if the price breaks down instead of breaking out in the direction we expect, our losses are limited. And for a bearish flag or pendant, we'd place the stop loss just above the upper trend line.
Okay, that makes sense. Now, what about profit targets? How do we determine where to take profits when treating these continuation patterns?
There are a few different approaches, and the best one often depends on your individual trading style and risk tolerance. But one popular method is to use the height of the flagpole as a guide.
The flagpole, how does that work?
So you measure the distance from the bottom to the top of the flagpole, and then project that same distance upward from the breakout point. And that projected level can serve as your profit target.
So if the flagpole is, say, $5 tall, and the price breaks out of the flag at $50, we'd set our profit target at $55.
Exactly. It's a simple yet effective way to estimate the potential move based on the initial momentum. Of course, you can always adjust your target based on other factors like resistance levels or overall market conditions.
This is great. So we've got our entry point based on the breakout, our stop loss to manage risk, and our profit target to aim for those sweet gains. I'm feeling that I'm starting to get the hang of this.
That's great to hear. And the more patterns you learn, the more tools you'll have in your trading arsenal. Now, are you ready to tackle another pattern that captures the rhythmic nature of the market?
Absolutely. Bring it on.
All right. This one is called the ABCD pattern, and it's all about identifying those waves of price movement that ebb and flow like the tides.
Ooh, sounds intriguing. I'm picturing myself surfing those market waves for profits.
I like your enthusiasm.
Uh-huh.
So imagine the price of a stock is moving upwards, forming a wave from point A to point B. This initial uptrend is crucial because it sets the stage for the pattern.
Got it. So A to B is our initial upward wave. What happens next?
Then, the price pulls back slightly, forming a corrective wave from point B to point C. This pullback could be a simple retracement or a more complex pattern, but the key is that it's a counter-trend move, moving against the direction of the initial uptrend.
Okay, so A to B is up, B to C is a pullback down. Where does the D come in?
Point D is where we aim to catch the next wave. After the pullback to point C, we expect the price to resume the initial uptrend and move higher, forming a new wave from point C to point D.
Ah, so the ABCD pattern helps us anticipate that second upward wave and ride it for potential profit.
Precisely. It's like catching a wave after it recedes and builds momentum again.
Absolutely. But remember, patterns are not foolproof. It's essential to use other forms of analysis, like technical indicators and price action confirmation, to validate the signals. Now, I'm curious, are there any other patterns that help us anticipate these types of wave-like movements?
There are, and there's one in particular that's known for its reliability as a potential reversal signal. The head and shoulders pattern.
Ah, the infamous head and shoulders. I've definitely heard of this one. It literally looks like a head and shoulders on the chart, right?
You got it. It's one of the most visually recognizable patterns in technical analysis. So imagine this. The price rallies, forming the left shoulder, then pulls back slightly. It surges again, forming the head, which is higher than the left shoulder, and then pulls back once more. Finally, it rallies again, but this time it fails to reach the height of the head, forming the right shoulder, which is roughly the same height as the left shoulder.
Okay, I can picture the head and shoulders emerging on the chart, but what about the neckline? I've heard that's an important part of the pattern.
You're right. The neckline is a trend line that you draw connecting the lows between the left shoulder and the head and right shoulder. It acts as a support level. And when the price breaks below this neckline, it often signals a potential trend reversal, from an uptrend to a downtrend.
It's like the market's giving us a big visual clue. Hey, things might be heading south.
Exactly. And just like with other patterns, we want to see confirmation before acting on the signal. In the case of the head and shoulders, confirmation comes when the price breaks decisively below that neckline, accompanied by increased volume and supportive signals from other indicators.
So we're not just looking for the shape of the pattern, we're also analyzing the price action, volume, and other indicators to confirm the signal.
Precisely. Now, to trade the head and shoulders pattern, you would typically enter a short position as the price breaks below the neckline. Your stop-loss order would be placed just above the right shoulder to minimize potential losses if the breakdown fails.
Makes sense. And how about profit targets? How do we determine where to take profits when trading the head and shoulders?
One common technique is to measure the distance from the top of the head to the neckline, and then project that same distance downward from the neckline break. That projected level can serve as a potential profit target.
So the height of the head determines the potential extent of the downward move.
That's the idea. Of course, you can always adjust your target based on other factors, like support levels, overall market conditions, or your own risk tolerance.
This is all incredibly insightful, but I have to ask, if the head and shoulders signals a potential reversal from an uptrend to a downtrend, is there a bullish counterpart that suggests a reversal from a downtrend to an uptrend?
You're one step ahead of me. Yes, there is. And you might have already guessed its name, the inverted head and shoulders.
Ah, so it's essentially the same pattern, but flipped upside down.
Exactly. Instead of peaks forming the head and shoulders, you have valleys forming the head and shoulders. And instead of a neckline acting as support, you have a neckline acting as resistance.
So if we see an inverted head and shoulders forming after a downtrend, and the price breaks decisively above the neckline, that would be a signal to enter a long position, right?
You got it. And the same principles apply. Look for confirmation from volume and other indicators. Manage your risk with a stop-loss order placed below the right shoulder, and aim for potential profit targets based on the height of the head.
This is amazing. We've covered so much ground already, and I'm feeling like I'm starting to see the market in a whole new light. But there's still so much more to explore, right?
There is. We've only just scratched the surface of the fascinating world of swing trading patterns. There are many more patterns out there, each with its own unique characteristics and signals. Sometimes the market gives us clues about potential breakouts, those moments when a stock suddenly bursts out of a range and starts a new powerful move.
Breakouts, yeah, those are the exciting moves, the kind of moves that can really generate some serious profits, the kind of moves that make you feel like you caught a rocket ship taking off. But how can we anticipate those breakouts before they happen?
Well, that's where certain chart patterns come in handy. One pattern that often foreshadows a breakout is the symmetrical triangle.
Triangles. Now we're talking geometry. I remember those from high school, but how do they play out in the stock market?
So picture this. A stock's price is consolidating. It's moving sideways in a tighter and tighter range. It's making higher lows and lower highs, creating converging trend lines that resemble a triangle.
So it's like the price is being squeezed, building up energy, ready to explode in one direction or another.
Exactly.
Mm.
The symmetrical triangle doesn't tell us which way the price will break out, just that a breakout is likely. It's like a coiled spring waiting to release its energy.
Okay, that makes sense. So how do we trade this pattern if we don't know which way the market's going to jump? Do we just sit on the sidelines and wait?
You wait for the breakout. Once the price breaks decisively above the upper trend line of the triangle, that signals a potential bullish breakout. Conversely, a break below the lower trend line suggests a potential bearish breakout.
So it's all about being patient and waiting for that confirmation before making a move.
Exactly. You don't want to jump the gun and risk getting caught on the wrong side of the breakout. Once the breakout happens, you would enter the trade in the direction of the breakout, and you'd place your stop loss order just outside the opposite side of the triangle to manage your risk.
Okay, so if we see a breakout above the triangle, we go long, placing our stop loss just below the lower trend line. And if we see a breakdown below the triangle, we go short, placing our stop loss just above the upper trend line. Got it.
But what about profit targets? How do we determine where to take profits when trading these triangle breakouts?
There are a couple of strategies you can use. One approach is to look at previous support and resistance levels. If the price breaks out to the upside, you might aim for a previous resistance level. That's now acting as a potential target. Conversely, if it breaks down, you might aim for a previous support level that's now acting as a potential target.
So we're using those historical levels as guideposts for where the price might go after the breakout. Another method is to measure the height of the triangle at its widest point and project that distance from the breakout point to estimate a potential price target. It's a way to gauge the potential magnitude of the move based on the width of the triangle.
These triangles are fascinating. It's amazing how these seemingly simple shapes can reveal so much about potential breakouts. Now, are there any other patterns that can help us spot these breakout opportunities?
Absolutely. Another powerful pattern is the ascending triangle. And as you might have guessed, there's a descending triangle too. They're like siblings, each with its own personality and tendencies.
Okay. So we've got symmetrical triangles, and now we have ascending and descending triangles. I'm starting to see a family tree of patterns forming here.
That's a great way to think about it. These patterns are all related in a way, but they each provide unique insights into market behavior. So let's start with the ascending triangle. They typically form during an uptrend.
So the stock is already on an upward trajectory, and this pattern suggests that the upward momentum is likely to continue.
Exactly. So imagine this. You have a series of higher lows forming an upward sloping trend line. But at the top, you have a horizontal resistance level, like the price is hitting a ceiling.
It's like the stock is trying to push higher, but keeps getting held back. It's building up that breakout energy we talked about earlier.
Precisely. The ascending triangle suggests that the buyers are getting stronger, and a bullish breakout above that resistance level is becoming more and more likely.
Okay, I'm seeing the potential here. So how would we trade an ascending triangle?
So you'd wait for the price to break decisively above that horizontal resistance line. That's your signal to enter a long position. You would place your stop loss order just below the lower trend line of the triangle to manage your risk.
And for profit targets, we could use those same strategies we discussed with the symmetrical triangle, previous resistance levels or projecting the height of the triangle.
You got it. Now, let's talk about the descending triangle, the bearish cousin of the ascending triangle. As you might expect, it's essentially the reverse of the ascending triangle.
So instead of higher lows, we have lower highs, forming a downward sloping trend line.
Yes. And instead of horizontal resistance, we have a horizontal support level acting as a floor. The price is trying to find support, but the sellers are in control. increasing the likelihood of a breakdown below that support.
And that breakdown below support is our signal to enter a short position, right?
Exactly. Your stop loss would be placed just above the upper trend line of the triangle.
Triangles, breakouts, this is all starting to feel like a high-stakes game of market geometry. What other patterns should we have on our radar?
Let's talk about wedges.
Wedges, like a doorstop. Are we going to start using those to hold the market up or down?
That's a good one. But seriously, wedges are similar to triangles in that they show a converging price range, but the trend lines are angled instead of straight.
So the price is getting squeezed, but instead of straight trend lines, they're sloping.
You got it. There are two main types of wedges, rising wedges and falling wedges.
Okay, let's start with rising wedges. What do those tell us?
A rising wedge forms when both the upper and lower trend lines are sloping upward, but the upper trend line is steeper than the lower one.
So it looks like a wedge that's tilted upwards, like it's getting ready to launch something into space.
Exactly.
Yeah.
The key takeaway here is that rising wedges, despite their upward tilt, are often bearish signals.
Wait, really? Why is that? It seems counterintuitive. If the price is making higher highs and higher lows, shouldn't that be bullish?
You'd think so, but the fact that the upper trend line is steeper than the lower one suggests that the buying pressure is weakening. The bulls are having to push harder and harder to create those higher highs, but they're meeting increasing resistance. It's a sign of exhaustion, like they're running out of steam.
So it's like a warning sign that the upward momentum might be fading, and a reversal could be on the horizon.
Exactly. That's why rising wedges often precede bearish breakdowns. You trade it by entering a short position when the price breaks decisively below the lower trend line of the wedge, and you place your stop loss order just above the upper trend line.
Okay, that makes sense. Now, I'm guessing that those falling wedges are the bullish counterpart.
You're catching on quickly. A falling wedge has downward sloping trend lines, with the lower trend line being steeper than the upper one.
So it's a wedge that's tilted downwards, like it's sliding down a slope.
Precisely. And despite the downward price action, falling wedges are often bullish signals.
I'm starting to see a pattern here. It's all about looking for those subtle clues in the trend lines to understand the underlying forces at play.
Exactly. Falling wedges suggest that the selling pressure is weakening, and the price is likely to break out to the upside. You'd enter a long position when the price breaks above the upper trend line of the wedge, and place your stop loss order below the lower trend line.
These wedges are fascinating. It's amazing how these seemingly simple shapes can reveal so much about the underlying market dynamics. We've covered a lot of ground here. Triangles, breakouts, wedges. I feel like I'm becoming a chart pattern detective.
That's the spirit. And there's one more pattern I'd like to introduce you to before we wrap up this pattern-packed episode. The rectangle.
Okay, rectangle. What do they tell us?
Rectangles are consolidation patterns that form when the price is bouncing between a well-defined support level and a resistance level. It's like the price is trapped in a sideways range, drawing a rectangle on the chart.
So it's literally drawing a rectangle. That's pretty straightforward, visually speaking. But how do we interpret these rectangles? Are they bullish or bearish?
Good question. Rectangles can be either bullish or bearish depending on the preceding trend.
Okay, so if a rectangle forms after an uptrend, it's more likely to break out to the upside, continuing the existing trend.
Right. Exactly. In that case, you'd look to enter a long position when the price breaks above the upper boundary of the rectangle and place your stop loss order below the lower boundary.
And if it forms after a downtrend?
Then it's more likely to break down to the downside. You'd enter a short position when the price breaks below the lower boundary of the rectangle and place your stop loss order above the upper boundary.
Rectangles, wedges, triangles. We've covered a lot of ground here. It's like we've assembled a whole toolkit of patterns to help us decode the market's messages. But I have a feeling there's always more to learn, right?
Absolutely. We've only scratched the surface, but you now have a solid foundation in some of the most common and powerful chart patterns used by swing traders.
This has been an incredibly insightful deep dive, but before we completely wrap things up, I'd love to get your thoughts on how we can take this knowledge and actually put it into practice. You know, I'm eager to start spotting these patterns in the real world and making some, winning trades.
That's a great question. And you're right. Knowledge without action is like a car without an engine. You need to put it to work to see results. So for all of you listening out there who are fired up and ready to start putting this knowledge to work, here are a few key things to remember. The biggest thing is patterns are just one piece of the puzzle. Don't forget to combine them with other forms of analysis. Think about technical indicators like moving averages or RSI. And of course, don't forget the fundamentals of the company you're looking at.
Right. It's not just about seeing a shape on a chart and yelling buy.
Exactly. Don't jump into trades just because you think you've spotted a pattern. Wait for confirmation. Does the volume support the move? Are other indicators aligning? Always manage your risk and have a plan before you enter a trade.
I think that's great advice for any kind of trading, not just swing trading, you know? Plan your trade and trade your plan, as they say.
Couldn't have said it better myself. And always remember, the market is a living, breathing thing. It's constantly evolving, so staying curious and adaptable is key. Never stop learning.
I'm getting the sense that learning is a big part of what you enjoy about trading. Is that right?
Oh, absolutely. I love the challenge of figuring things out, of seeing something new in the charts and understanding why it's happening. There's always something new to discover in the markets.
Well, I have to say, you've definitely opened my eyes to a whole new way of looking at charts. I'm starting to see patterns everywhere now.
That's great. That's the first step to becoming a successful swing trader. Once you start to recognize these patterns and understand the underlying forces driving them, you can really start to anticipate market moves and make more informed trading decisions.
You know, this whole deep dive has been like getting a backstage pass to the market. I feel like I'm finally starting to understand the secret language of the charts.
And remember, practice makes perfect. The more you study charts, the more comfortable you'll become identifying these patterns in real time. Don't be afraid to experiment, to test your theories, and to learn from your mistakes.
That's some really solid advice. So for all our listeners out there who are feeling inspired and ready to take on the world of swing trading, what's the one key takeaway they should remember?
I think the most important thing is to approach swing trading with a mindset of continuous learning and improvement. Embrace the challenge, be patient, and most importantly, have fun. And who knows, maybe you'll be the one to discover the next big trading pattern.
Hey, a trader can dream, right?
Absolutely. That's what keeps things exciting. Until next time, keep those charts open, keep studying, and keep those trading profits rolling in.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.